On the heels of a solid few weeks in the markets, the November jobs report added further evidence of general economic health, with a labor market that is slowing but not nearly grinding to a halt. After a dismal October payroll report that was complicated by strikes and weather, hiring rebounded by a better-than-expected 227,000 jobs in November. The private sector was the main hiring engine, with job growth strongest in leisure and hospitality and in healthcare. But this report wasn't all good news either, as the household survey painted a gloomier picture. The unemployment rate ticked up to 4.2%, which is the same level that it reached in July when it rattled markets and triggered the Somme rule. However, what we've learned since July is that demand for workers is still supportive and bolstered by strong GDP growth. The uptick in unemployment bears watching, particularly given wide survey discrepancies. However, we still believe that investors should focus on the broader mosaic of employment data. If the payroll numbers had been weak for a second month in a row, alarm bells would be ringing. Instead, in addition to strong payroll gains, we've seen claims for unemployment insurance remain muted. There is still roughly one job opening for every unemployed person in this economy. And while labor conditions have notably cooled, so has inflation, enabling growth in household purchasing power that's helping power holiday spending this season. On balance, this report may tilt the scales towards a December cut as we continue to parse through the fogginess in jobs data and the stalling out in inflation. But we're likely still facing a shallower easing cycle than markets expected earlier this year. Paired with robust growth, disinflation, and healthy earnings, a cautious Fed seems unlikely to derail a continued equity rally, though, into the new year.